Now that I bought while interest rates were high, what do I do while I'm waiting to refinance to a lower rate? In the beginning months of your loan, a majority of the payment goes to interest, and your interest is based off the remaining balance. You are cutting the loan by a lot for any extra you put to your principal payment. Hello everyone, this is Melissa Grace here again. I wanted to answer a question that a follower had asked me recently. They asked me, now that I bought while interest rates were high, what do I do while I'm waiting to refinance to a lower rate? Let me first start by saying congratulations for going against all the naysayers and getting into a home that you can afford right now. You can never go wrong by buying right when you can if it is a long-term investment or owner-occupied home. Buying when interest rates are high means you get the house for a better price. Typically, since competition is low, you won't overpay for your home in a bidding war. Now let's get to the answer of the question. Usually you have to wait to refinance a minimum of 6 months from your first payment, which means 7 months from closing to about a year. Average is 122 days until you can refinance. While waiting, you really want to do the same thing you were advised while you were purchasing. Don't run up your credit. Don't do any Affirm or pay-as-you-go plans. For optimal credit, you want to keep your credit cards to about 30% usage or less. Always pay on time. Any lates can delay your refinance. If you can, don't do any furniture or etc. on credit. Just don't overspend. Don't do any unnecessary upgrades to your home that will not add to the value. Please know that any debt you add to yourself changes what is called your debt-to-income ratio. Depending on the loan program, you don't want to go above 40% debt to income to bring in. It can be higher or lower based on the program, but good call, 40%. Your debt to income ratio is what the banks use to see if you can afford the monthly payment. So keep that low. Your debt needs to be lower than the income you make. In the beginning months of your loan, a majority of the payment goes to interest, and your interest is based off the remaining balance. You are cutting the loan by a lot for any extra you put to your principal payment. At this point, any extra money you get a month, say you get a bonus or you have extra income coming in, I suggest you put that towards paying down your principal on your home. You can always send any extra you want each month and state the extra goes towards your principal. A portion of your payment goes to pay down the balance of your loan, and then a portion of your payment pays the interest, which is the interest rate you're paying over 30 years. So paying down towards your principal means by paying down your balance of your loan. In the beginning months, a majority of your full payment goes towards the interest, and the latter goes towards your principal. So what you want to do is send in a payment, and any extra towards your payment, you're going to say the remaining balance goes to pay towards principal, because if not, they'll put it towards your interest at some point. But you're cutting off a lot of your remaining balance by sending the extra amount to your loan, if that makes any sense for you. If it doesn't, please reach out to me. Some months, you may not be able to pay the extra, which is fine, but whenever you can, you should. This will help you save on your mortgage insurance as well when you refinance. So say you're paying enough extra that you can pay towards that 20% that you need to remove your mortgage insurance. That will help cut or remove your mortgage insurance on your refinance. So you can never go wrong basically by paying on your principal any extra money you have. Right now, I'm dealing with a lot of this new issue. Because of the time of year. So let me get into this. Another thing I highly suggest, whether you refinance or not, is to make sure you have a CPA or tax person that understands real estate. Once you buy property, this is important for you. How you file your taxes is critical for qualifying for your refinance or even making a purchase to begin with. Making sure you file according to the real estate goals you have coming up. Sometimes that spur of the moment thing happens and the right home comes at the right time and it's just possible, which is great. But if you know, I'm going to be preparing to purchase a home and you're setting up that plan, make sure you set up with a tax person that is able to help you achieve that plan with your taxes that you're going to submit for the lender who's going to qualify you. You can also ask your lender to help for advice as well as to how to file your taxes. The lenders can advise you what the lenders look for. They can't give you tax advice, but they can tell you based off their experience. A great example of what I'm talking about is, did you know that where you put the interest you write off on your return determines if the lender can add that back in as income, or they have to remove it as a debt, an expense on your application. Also, where on your taxes you put repairs and depreciation is important. Having the right tax person can make or break your loan sometimes. Here are just a few things to think about. If you want to talk more about any of these or have any other questions, please reach out. I would love to walk you through your dreams and see how I can help you make them a reality.